Hello and welcome to Financial Education for the Nation. My name is Warren Shute, and how are you today? I hope this message finds you well. Seasons have definitely changed. It's a bit cold and wet outside my door today, so I don't know what the weather's like when you listen to this. And wherever you are in the world, obviously you might have a glorious sunshine and keeping your spirits up. Talk about glorious sunshine, bright yellow, shiny thing, gold. We're going to talk today about gold and whether gold should be included in your investment portfolio. Some people like to wear gold, some people worship gold, but is gold an investment? Is gold a contingent part of your portfolio asset allocation, and should you include it? So I think to answer that question, we got to say is, what is gold? Is it an investment? And once we know if it's an investment or not, should we include it in our portfolio? Because if we're going to include it in our portfolio, we're going to take something out. So how is gold actually performed or measured up against alternative types of investment? And then once we've covered those, we'll look at the actual performance history of that and then kind of conclude to see how it all runs together. Okay, so starting off with, what is an investment? Let's start with that. What is an investment? So I obviously have my own opinion on what an investment is. Working with clients for the last 25 years, you really understand the difference between an investment and either a scam or a scheme. But one of the things that I did was I searched around on the internet. I looked at some of the different sites and I came up with various different definitions, but there was a consistent theme across all the definitions. And that consistent theme was, an investment is an asset purchased with the idea that the asset will provide an income in the future. Okay, so if we look at that as a definition, so it's an asset that we purchase that will provide us an income sometime in the future. And when you get into the investment world, we call those incomes cash flows, so future cash flows. So what are those cash flows in the future? So if we look at a couple of examples now, we would all probably agree that a share is an investment, a share in a company, and that's an asset, and those future income streams, those future cash flows would be the dividends that the company pays out. Some people would even calculate it on the profit that the company makes, because that potentially could be paid out and the company hasn't paid it out, so it's reinvested it within the company to make the company worth more, so more valuable. We tend to see this a lot in growth companies, that they will make big profits, and rather than pay out the dividends to the shareholders, return the money, they keep the profit within the company and they buy other companies sometimes, or they grow the company in size, so they build the company in size, making it more valuable. So that's one example, looking at a share. A second example, which I'm sure is on the forefront of your mind, I'm sure if I said buy-to-let properties, exactly that. So a buy-to-let property, buying a property as an asset, and the future cash flows, income streams are, of course, the rents that are paid by the tenants in the property. And it's quite easy to see that in practical terms. The rents get paid out to you, receive those. The house price typically is dictated by the rental yields, and not many people sort of necessarily appreciate that. It is done on supply and demand, I completely agree. But the property price will generally keep pace with inflation over long stretches. I know we have condensed periods where they've gone wild, just like in the stock market, we have bubbles. But the property price generally keeps pace with inflation. That's because the rentals are rising with inflation, and they rise with inflation typically because wages rise with inflation. And over time, so we always have bubbles and extremes, but if you average those out, but generally speaking, that's what they work out to be. If you look at commercial properties, they generally are valued on the lease, on the rent of the property, what the long-term rent is. You capitalise the rent by a yield, by a percentage rate, and that gives us a capital value for the building itself. And that's a good way of comparing properties like for like over time. And it looks on the quality, the covenant of the tenant. How strong is that tenant to pay? How likely is it to pay the rent on that? So you can see two quite clear examples of investments: a share in a company and a property, both providing income streams. Now let's look at gold. Gold doesn't provide us any income. There's no income stream paid from gold. I guess in theory we could let gold out and you rent it to somebody, and therefore when we rent it to somebody they would pay us an income, but that's an unusual sort of thing to do. If we look at gold on an investment scale, not on a jewelry basis, but on an investment scale, if we're buying gold bullion bars, so lots of different bars of gold, we need somewhere to store that. It might be quite high risk to keep it in our house. So I'm sure some people will keep it in their loft or in their basement or possibly in their garage. Seems quite risky to me. If you're broken into, there's a lot of expense there, exposure. So we need some kind of storage facility. Therefore, it's costing us to look after this. And then in addition to that, we probably would insure it as well. So far, that looks like a liability to me. I have something and I have to pay to keep it. So we're not it doesn't really look to be stacking up to be an investment. Okay, an investment is an asset that we buy that produces us future income streams, whereas the gold bullion at the moment is going to be stored somewhere. So we have storage costs, and we possibly even have insurance costs as well if we want to insure it against possible fire or theft or something like that. So it's not produced us an income. Now, same with wearing jewelry, either on a watch or a bracelet or a ring or something. It's not produced us an income. So is our jewelry really an asset? Possibly not, but I do understand why people buy it. If we fall on hard times, we potentially could sell that and realize it back to cash. There might be some kind of value there. So if gold is not an investment, then what is it? What is gold if it's not an investment? Well, let's have a look. The most common investment in gold really would be through an exchange traded fund, an ETF. Now, an exchange traded fund, an ETF, is a company that is listed on the stock exchange, the London Stock Exchange, and the purpose for that company is to hold investments. Investment is an investment company, very similar to, I guess, an investment trust. So you can buy a gold ETF, an exchange traded fund. It's called, I'm just looking at my notes here, the iShares Physical Gold Fund. That pays no income, so by definition it's not an investment. But when you look at it, it's actually an ETC, not an ETF. Okay, so we have exchange traded funds, ETFs. This is an ETC, so it stands for an exchange traded commodity. So by definition of this, it's saying it's not an investment, it's a commodity. And when I looked up what a commodity is, obviously you know what a commodity is, but let's look at a definition of what a commodity is. It's a raw material that can be bought or sold. So you can see by that we're just looking at an innate physical raw material, an object that can be bought and sold. And the price of gold will fluctuate in accordance to its supply and demand. So if there's a lot of demand for something, demand is high, resources are scarce, the price will appreciate. But if the resources are vast and the supply is scarce, so very few people want it, the price tends to come down to a price until there's a market for it. So you've got supply and demand. Now, that's not my idea of investing for the future. I want to be able to calculate with a reasonable level of accuracy, okay, with some kind of track record, how my investments are likely to perform going forward. And that's how a share is calculated, by discounting, bringing back into the present those future cash flows and then capitalizing on the value. Whereas with gold, whether it's an ETC, an exchange traded commodity, or whether it's gold bars, the price of these golds are fluctuating relative to supply and demand. So gold's always been a safe haven during uncertain times. So during uncertain times, recessions, economic contractions, when the stock market retraces and pulls back, uncertainty, scarcity comes out, money tends to flow into gold because it's traditionally been a safe haven. Okay, now when that happens, the price of gold generally appreciates in value, goes up, and therefore you've got the protection, as it were, of gold backing you. I'm not so convinced it's a protection myself, but that's the way it's portrayed, as a protection mechanism, as a physical raw material. I think that's really where why people invest in it. But you've got to remember, you can get that physical raw material, as it were, through share investing. You own a slice of a company. If that company is sound and solid, you've got assets, you're buying it at a good value. When you buy into buy-to-lets, into rental properties, you're buying bricks and mortar. These things do fluctuate in value. And that fluctuation is your reward for putting your money at risk in the capital markets. Okay, so you place your money into an investment, and your return is linked to the risk in which you take. And that's where the saying risk and reward are correlated or connected. If we put our money in premium bonds, or we put them in cash savings, we have no fluctuation in price, but our return is minuscule, very less than 1% typically. We then have the way the banks make the money typically is they take the money and they invest it. But we could do that, so we take our money, we decide not to put it in the bank, but we put it into the stock market. We're going to see our investment fluctuate in price over time, and because of that uncertainty, over the longer time, we are rewarded for that. So we're giving a return, and that return comes from the companies reinvesting their profits, growing the value of the company, and then becoming more valuable, so people pay more for it in the future. So you've got another sort of angle there, really, of looking at whether gold really could be an investment in any shape or form. When something's working on purely on supply and demand, there's no real way of you calculating what the future of this is going to be. Therefore, I would really sort of exclude it as an investment per se. And then we come on to performance, and how is gold performed relative to our other alternatives? Okay, so we'll have a look at that next. So we'll look at the performance of gold relative or compared to the world stock market. I think that's the fairest comparison that we can do, and the reason I say that is because gold is valued in US dollars, the world stock market index is valued in US dollars, and there's various world stock market indices we can use. If it's a broad one, you've got the likes of the FTSE All Companies World Index. You've also got the MSCI World Index. It doesn't really matter which one you look at. They're both very, very similar in their returns. And if we look at them, how have they performed over time? And accompanying with this, you've got a chart. Accompanying this video, there's a chart as well that you can look at warrenshute.com, which will explain the pattern on how these two things have performed. So let's first look at gold. So if we'd have bought gold back in 1986, that's just over 33 years ago from the date of this recording, 33 3/4, so I guess it's nearly 34 years ago, gold would have appreciated over that time a reasonable, a respectable 435%. So 435% is a significant return in isolation, but it's over nearly 34 years. And that reduces down to about a 5% return a year. So it's not done too bad, if I'm honest. It was possibly more than I expected it to do. I didn't think it was so high as that. But one thing I did learn from this is everyone talks about gold as being a safe haven. It wasn't really a safe haven. It had its highs and its lows. It pulled back. So I wasn't so impressed with its safety angle as much as I was actually pleasantly surprised at its return. Now, if we then compare that to the world stock market, the world stock market over that almost 34-year period had returned over 2,000%. So what's that? Nearly 5 times as much. So it's just mind-boggling if you look at the difference. So 435% return compared to 2,000% return. And that annualizes just over 9% per year, which we've always spoken about as being the return given to the world stock market performance. So then you can ask the question, well, are they a fair comparison? Are they fair? Well, they're both valued in US dollars, so they're both international investments. They're both widely owned. I guess you could argue that the world stock market is by far more diversified. With that, you would expect the return to be slightly diluted, okay, because you're owning winners and losers. So it's a wider diversified portfolio or investment, so you'd expect it to be diluted. It's actually performed nearly double 9% a year relative to 5% a year. So that doesn't really stack up, unfortunately. They are very similar in risk. The drawdowns of these was remarkably similar, a lot more similar than I expected them to be. The volatility, etc. It was a lot higher in gold than I actually expected it to be. I think that you have it that gold by definition is not an investment. Although many people will see gold as an investment, it isn't an investment. It's just a commodity that can be included in your portfolio if you wish, but really it's not there to gain you returns. The performance of gold is not in line with other investments that are available. You've got the world stock market returning just over 9% a year when gold is returning about 5% a year, but the risk of both are fairly similar. So it kind of discounts it as an investment. However, if you do want to hold gold in your portfolio, because it's not for any one person to tell you what you should and shouldn't do, you just lay the facts out and give you the information, and then you're able to make the informed decision yourself. If you do want to invest in gold, then limit your exposure to gold to no more than, say, 10%, preferably nearer 5% of your portfolio. We do run one portfolio that includes gold in our remit, but that's one out of, 14 or so different portfolios that we have. It's often, as I said at the beginning, it's often seen as a safety asset, a flight to safety. If things go wrong, people go into gold, and that would be really the reason that you'd be putting it in there. I think higher inflation times, people tend to fleet to gold, so you never know. A bit of research that I looked into, I'm just going to look at the figures now just to make sure I get it right, which really surprised me as well. We talk about this flight to safety. I'm not overly convinced on that because I was looking at the figures. Gold had a drawdown as much as 45% at one point. So that means from the high to the low had a retracement of 45%. Now, if you listen to these recordings often, you'll know that I talk about the stock market having a retracement of 50% from a high to low. So give or take, it's there with the overall stock market. So I don't feel personally it's a flight to safety. So then although that's how it's been advertised, so I then had to look at the data and say, okay, what did the data say? In the 3 years to the financial crisis in 2007, so the 3 years in the run up to the financial crisis in 2007, that was a difficult time. That would be a typical time for a flight to safety. Okay, gold actually appreciated 63% over that time. In those 3 years, gold appreciated 63% relative to the world stock market, which only appreciated 45%. I say only. Simple annualized return is 15% there, so it's phenomenal. But gold appreciated 63% in those 3 years. Simplified, about 20% return a year. We're looking at 5 long term. You can see money was flowing into gold in the 3 years up to the 2007 financial crisis. Okay, that's an isolated instance. What other instance could we look at? We could look at the 2000 dot-com bubble. That was the one prior significant stock market correction. So in the 3 years into the run-up to December 2000, gold appreciated 8%. Okay, so 8% in the whole 3 years. not in per year, but in the whole 3 years, whereas the world stock market appreciated 60%, 60. So now you've got some kind of discrepancies, and I think this is how information is sold to retail investors. They get an isolated incident and they say, during uncertain times, gold appreciates. Hey, look, at the 2007 financial crisis, 3 years in the run-up, gold went up 63% when the world stock market only went up 45. Gold is a place to be to save your money in a financial crisis. Okay, so let's look at a previous example. We look at the dot-com bubble, which was the prior significant drawdown in the world stock market. I think the market retraced about 45%, 47% there. Gold only appreciated 8% during those 3 years, whereas the world stock market appreciated 60%. So I'm not sure I would say that gold is a safe haven. I know historically people talk about money flying to gold during uncertain times, and that might be the case. But if you're an investor, investing for the long term, you want to buy investments. And investments, as we've defined, is an asset that will produce us cash flows. And those cash flows can be used to value the current value of the investment, so we know we're buying at fair value. Gold doesn't meet that objective. So when we look at the performance of gold over time, gold's averaged about 5% return a year with a maximum drawdown of 45%. So that maximum drawdown is on comparison with the world stock market, but the world stock market has returned over 9% return per year. So I know where my money would go, certainly in that example. The other thing we need to look at is in the last 5 months, since May 2019, we've seen gold rise 24%. Who knows? Is it on supply and demand? Is it because of Brexit? Is it because of uncertainty? What does the future hold? We don't know. And this is the thing with investing. You are rewarded as an investor for putting your money in the markets and accepting that volatility, and you are rewarded over time. We looked at the chart of the world stock market since 1982, I think it was, returning you 9% return a year. That is a handsome return over the long run. There are years where you receive a negative return, and you must be sure of yourself to be invested in those markets to accept those negative returns, because if you don't, if you bail out, you never then receive the positive returns. It averages itself out over time. So investing is a long-term game. Investing is a long-term game. When you invest, time is your friend. The more time you have, the better. We often say invest for at least 5 years, preferably 7. So if you've got less than 5 years, you really should be looking at cash or cash equivalents. And the reason being is you don't have the time to ride out the ups and downs in the market. We say 7 because typically from a high to a low, it takes that period of time to recover any losses. So if we were, and I don't think we are necessarily, but if we were in a November 2007 sort of situation now and the markets were to start correcting, it takes about 7 years for it to go down and recover. Now, that's what's happened in the past. We don't know what's going to happen in the future, but we've got 2 significant events that we can call upon to help guide our decisions. But the most important thing is to ask yourself, how much can the portfolio go down before you begin to feel uncomfortable? And the second question is, how much can the portfolio go down before it affects my lifestyle? And once you get the answer to those 2 questions, you'll then be able to make an informed decision on what kind of portfolio, what kind of investment you actually go ahead with. And it's important you don't take more risk than you feel comfortable with, but in the same breath, you will be penalized if you don't take any risk, because holding money on deposit at about 1% a year, inflation's running at over 2% a year, after tax, you're actually making a negative return. You're sitting on the back foot. So there you have it. Gold is not an investment. Look at equities, look at funds, look at trackers, invest for the long term, keep your fees down and stay in the market through the ups and downs. My name's Warren Shute. This has been Financial Education for the Nation. If you have any questions, please reach out. I'm still replying to all the questions that come in, although I do spend a lot of time doing that now, which is great, and I do appreciate it. I'm certainly not putting you off. I'm here to serve you, to help you make better, informed investment and financial planning decisions. Until next time, take care.